Hi, and welcome to my monthly market insights video. This is Dan Timitich. I'm a managing principal and a portfolio manager at T2 Asset Management. We've got a lot to cover this month, but before we get started, remember this video is for educational purposes only. Opinions expressed in this video are mine and do not reflect the opinions of other portfolio managers. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, what a tough month of October we just experienced. We did see some painful performance in October across really all sectors and all markets. But before we get into the reasons why, I think it's important for people to understand that markets oftentimes have these kind of corrections within a bull market. We saw a couple of them earlier this year. To start the year, we started out really strong, and then we saw the market pull back about 11%. Shortly thereafter, we saw another 8% pullback before we went on a pretty good run up until the end of September. And then obviously we ran into October. It's not, this isn't something that's unusual, but we can't ignore it. We have to understand why this has happened, and we have to be able to analyze it to make a determination whether this is something more serious than just a normal pullback. Times like this are going to require a thorough understanding of economics, investment management, capital markets, and portfolio construction. So let's take a look at some of the reasons I think led to this recent pullback. I think it was four things. First, interest rates significantly increased in recent weeks. We saw concerns over earnings growth and the potential for earnings hitting peak levels. We have the midterm elections coming up here next week, and then the Federal Reserve has been on an interest rate hiking path. So we'll take a look at all those implications. First, looking at interest rates. This chart here shows the 10-year Treasury rate, and as you can see, since mid-August, we've seen a significant increase in the rate where it peaked out at about early October. What this did was force portfolio managers to revalue their models, and it started causing a rotation out of some of the high momentum names which had such terrific performance for the year, and that sparked the selling. And then once the program traders and the algorithms kicked in, the selling just accelerated. You got to remember, once these computer programs take hold of selling pressures, it just really exacerbates the sell-off. So it appears towards the end of October that we did see some stability in the last couple of days, so hopefully the worst is behind us. The second issue that the markets were concerned about was earnings. And what we saw coming off the second quarter earnings was really good earnings growth. And while we can't expect earnings to grow at 20-25% indefinitely, earnings did come in pretty strong for the third quarter. As of right now, it appears that about half of the companies in the S&P have reported. About 77% of those have beaten estimates. So earnings have been very, very strong. And as you can expect, the strongest numbers came from technology, communication services, and healthcare. So while earnings have been strong, a lot of these companies have been punished for guidance and for revenues. And just as an example, let's take a look at a few companies that people are familiar with. Amazon had terrific earnings report. They reported $575. That was up 13% from the previous quarter. But their revenues, even though they were up from the previous quarter about 7%, they didn't quite hit the levels that the street expected, and it punished the stock by selling off about 7%. Similar story for Alphabet, the parent of Google. Earnings were really good, or up 11% from the previous quarter, but revenues were on the softer side. That caused their stock price to fall about 10%. And then IBM, similar situation. Their earnings were up about 11% from the previous quarter, but the revenues were really soft, and that stock just got pummeled. It was down about 24%. So it's pretty clear that the market wants more than just earnings. They want to see positive guidance and higher earnings going forward. I think that's something that the market's going to keep an eye on going forward, and I would expect volatility to continue into 2019 as these companies start to determine whether or not earnings are going to continue to grow at levels that the market is comfortable with. So Looking at fiscal and monetary policy, these two policies are very important to the economic stability and the growth of our U.S. Economy. The fiscal policy is set by Congress. That's where they establish tax rates and how the government spends our money. It also involves regulations from different agencies of the government on different industries. The monetary policy is where the Federal Reserve sets interest rate policies, and it has the dual mandate of holding full employment and price stability. These two policies rarely work in tandem. It's really more of a balancing act that needs to take place. Over the last couple of years, we saw a very accommodative fiscal policy. We've seen tax cuts and reduced regulations. That has allowed the Federal Reserve to be less accommodative and start to raise interest rates as well as unwind their balance sheet. Right now, the Federal Reserve has had the luxury of being able to raise its interest rate, given that the fiscal side of the equation has been so accommodative. But that leads us to more questions in terms of the midterms. And it's important for us to understand what the implications are with regard to the midterms and how fiscal policy will be dictated going forward. So let's take a look at some of the potential outcomes. If you believe the polls, it's probable that the Democrats will take the House. Republicans will hold the Senate. This will probably be more of a headwind to fiscal policy, given that these two parties can't really agree on anything. So any additional fiscal stimulus will be very, very much limited. An unlikely scenario would be for the Democrats to take the House and for them to take the Senate. If that were to happen, I think the fiscal policy would flip from being accommodative to being restrictive. Democrats have already indicated their willingness to reverse the tax cuts. So this is probably an unlikely scenario, but nonetheless, something we got to keep an eye on. Another unlikely event is that the Republicans hold the House, Democrats take the Senate. That would be similar to the first scenario where it would be a headwind to fiscal policy. And then the other possibility is that the Republicans hold the House and the Republicans hold the Senate, in which case fiscal policy would continue to be accommodative. This is something that I think is going to be important going into 2019, and we'll have to wait to see how the Fed reacts to whatever the results of the midterm elections are next week. So let's take a look at what's been happening with the economy. So real GDP here in green is clearly stronger in the recent year than it has been in quite some time. The red line here is the Fed's ability to raise interest rates in the face of an expanding economy. And then finally, this black line here is the inflationary rate that we've experienced over the last couple of years. So as you can see right here, we saw a little bit of a softening in economic growth in 2017 as the Federal Reserve was raising rates. It wasn't until the fiscal stimulus kicked in that we saw a pretty big jump in terms of economic growth. And that, again, has allowed the Federal Reserve to continue on a smooth, measured rate hike environment. Now, I think that it's important to understand that the Fed oftentimes goes too far, too fast. It doesn't appear to be doing this right now, but it's something that we're going to have to keep an eye on because the fiscal stimulus has allowed them to continue to increase rates. Looking here, it's important to understand that the Fed funds rate is an important measure. It oftentimes will be a precursor to future economic activity. So if you look here, whenever the Fed funds rate significantly exceeds inflation, it means that the Fed's really trying to fight out of control inflation. And oftentimes it's followed by a recession when they hike rates too far. We saw the same thing happen in 2007 or 2006 going into 2007, and we were followed by a recession as well. At this point, we're not at that level. The Fed seems to have been pretty methodical about their rate hike policy. And again, I think they're going to go ahead and reevaluate the economic numbers going into year end and establishing policy for the next year. So just something to keep in mind when we're looking forward over the next 6 to 12 months. At this point, I think people have experienced a pretty tough October, and I think that the most important thing is for them not to get emotional. I fear that many people may have sold positions in October, waiting for things to feel a little bit better. By definition, that's selling low and buying high, and I would strongly discourage people from doing that. At this point, the damage has been done, so we really need to be patient here, wait to see what the midterm election results look like, and then finally wait to hear from Chairman Powell for any indication in terms of any interest rate policy changes going into 2019. Thanks a lot for watching. I really appreciate it, and we'll have a lot more to say next month after we have the elections. Have a great day.